This presentation is going to take you through 3 types of depreciation calculations. The first method is straight-line method. The straight-line method provides the same amount of depreciation expense for each year of the asset's useful life. It is calculated by taking the cost minus the residual value and dividing that by the useful life in years. Let's look at this example. Let's assume we have an initial cost of $28,000, an expected useful life of 2.5 years, an estimated residual value of $2,000. We're going to take the $28,000 initial cost minus the estimated residual value of $2,000 and divide that by 2.5 years. We come up with an annual depreciation of $10,400. Straight line method, partial year. If a machine was purchased and placed into service on October 1st for $24,000 and had a residual value of $4,000 with an estimated life of 5 years, the depreciation for the first year of use would be the cost minus the residual value, $24,000 minus $4,000 to give us $20,000, and then the $20,000 divided by 5, which gives us $4,000 a year. And we're doing this for a part year, months October, November, and December, that's 3 months. 4,000 annual times the quantity, 3 divided by 12, which is 25%, which is going to give us $1,000 for the first year. The next method of depreciation is units of production. Units of production provides the same amount of depreciation expense for each unit produced or each unit of capacity used by the asset. It's a 2-step process. In the first step, we determine the depreciation per unit. This is determined by cost minus residual value divided by total units of production. In step 2, we calculate the depreciation expense. This is done by taking the depreciation per unit and multiplying it by the total units produced. In our example, a machine costs $24,000. It has an estimated residual value of $4,000, an expected life of 10,000 operating hours. During the year, the asset was operated 2,100 hours. First, we determine the depreciation hours. $24,000 cost minus 4,000 residual value equals $20,000. $20,000 divided by the life expectancy of 10,000 machine hours equals $2 per hour of depreciation. To determine the depreciation expense, we take the $2 per machine hour and multiply that by the 2,100 machine hours used during the year. This will give us an amount of $4,200. Our journal entry would then be the depreciation expense of $4,200 and accumulated depreciation $4,200. We're now going to look at double declining balance method. This method provides a declining periodic expense over the useful life of the asset. The double declining rate can be determined by doubling the straight line rate. So if you can calculate straight line, you double it, multiply by 2. There is a shortcut in determining the straight line rate, and that is to divide 1 by the number of years. 1 divided by 5 to give us 20% rate on straight line. And we multiply that times 2, we get a 40% rate for double declining balance. Let's take a look at an example. For the first year, the book value of the machine is an initial cost of $24,000. After the first year, the book value, cost minus accumulated depreciation, declines, and thus the depreciation also declines. Here we can see a chart of double declining balance. You can see that in year 1, we have year 1, accumulated depreciation thus far, 0. Then we have our beginning year balance, $24,000, that's the cost of our machine. Our double declining rate, 1 divided by 5, 20% times 2, 40%. And so 40% times the $24,000 gives you the depreciation for the year of $9,600. $24,000 minus $9,600 gives you the ending balance in this account for the year. In year 2, the accumulated depreciation that's already been taken care of in year 1 is right here, $9,600. Our beginning year balance is from last year's ending year balance. We take that balance multiplied by 40% and get $5,760. The $14,400 minus $5,760 gives us an ending balance of $8,640. So in year 3, we have accumulated depreciation of year 1 plus year 2 to give us a total depreciation of $15,360. The beginning year balance is then $8,640. We multiply that times the 40% rate and come up with depreciation for the year of $3,456. Our beginning year balance, $8,640, minus our depreciation for the year, $3,456, gives us an ending year balance of $5,184. In year 4, our total accumulated depreciation, this is the total in that T account, of each year we've depreciated thus far, is $18,816. Our beginning year balance would then be $5,184. If we multiply that times 40%, we get $2,074. We cannot use this amount. Right here. Stop at year 4. You must force depreciation this year. Depreciation must not take the asset below residual value. And residual value, we were told, was $4,000. So we can only take this number right here to $4,000. Depreciation for year 4 is the beginning balance for year in 3, $5,184, minus the $4,000 residual value we need to have to give us depreciation for the year of $1,184. Our entry for year 4 will be depreciation expense $1,184, accumulated depreciation $1,184. If double declining method were used when we bought something on October 1st as partial year, this would be our calculation for year 1. For year 1, we would have the $9,600 times the quantity of the portion of the year, 3 divided by 12, that's 25%, to give us depreciation in year 1 for a partial year of $2,400. Continuing on with a partial year beginning, the second year would then be $8,640. The second year depreciation following the chart is the $24,000 cost minus the accumulated depreciation in year 1 times the 40% rate, which gives us $8,640. The double declining balance method provides a higher depreciation in the first year of the asset's life, followed by declining depreciation amounts. And this is called accelerated depreciation method.